Today, we're going to learn about EBITDA. What is this strange language I speak? Well, stay tuned to find out. Welcome back to Fun Finance. I'm Blair Cook. Now, today we're going to talk about the metric I love to hate, EBITDA, which stands for earnings before interest, taxes, and depreciation. In today's episode, I'm going to cover off three things. First, I'm going to tell you how to calculate it. Secondly, I'm going to tell you how it's used in business today. And third, I'm going to tell you why it's not the holy grail of financial indicators that it's made out to be. So, let's begin with how to calculate it. This is kind of self-evident. Just follow the description. Earnings before interest, taxes, and depreciation. Do I really need to write this out for you? So, start with bottom line earnings and add back interest expense, income tax expense, and depreciation costs. Now keep in mind that depreciation costs may not be on the face of the income statement if there are costs buried in cost of sales. You can find out how much depreciation there is by looking at the statement of cash flows and checking with the notes to the financial statement. EBITDA is intended to be a proxy for the operating cash flow of the business. Now, there's a whole bunch of warnings that accompany this statement, but we'll get to those in a moment. The tricky part of calculating EBITDA is determining how to treat certain items in the financial statements. For example, what if we have a gain or a loss on disposal? How does that get included in EBITDA? How about investment income or other one-time charges? These are all common adjustments that issuers will make to calculate EBITDA because the term EBITDA is not a defined term under accounting standards. Let's move on to how EBITDA is used. Now, admittedly, I love the versatility of this metric. Wouldn't you agree, Jen? Investment bankers on Bay Street and Wall Street began popularizing EBITDA starting back in the 1980s. The metric is now embedded throughout capital markets. Let's discuss a few of the more common applications. First of all, EBITDA has always been a helpful valuation rule of thumb. I had a manager many years ago that said if you want to know the value of any business, start with 8 times EBITDA and adjust from there. EBITDA multiples contract when the business is small and private and more cyclical. EBITDA multiples expand when the business is publicly listed with high growth and a consistent history of earnings generation. So, a small private company that sells commodities, say an oil and gas company, might be valued at, say, 3 to 4 times earnings, whereas a company that earns a royalty streams off of licensing a very popular brand, say like a Hilton hotel or something, would have an EBITDA multiple of 10 or 12 times earnings. When you take EBITDA and apply a multiple, you are calculating what the valuation specialists call enterprise value. In other words, the value of the business without debt, which is not the same as equity value, which is calculated as enterprise value less the value of the debt. Let's look at a second application of EBITDA, and this has to do with determining how much financing a company can raise. A lot of lending agreements will specify the amount available for a senior lending facility, i.e. one that is secured, and this will be limited by an EBITDA coverage ratio. So what is this coverage ratio? Well, if the coverage ratio specified in a lending agreement is, say, 3 to 1, this means that if you have EBITDA of, say, $100,000, the bank will only lend you up to $300,000. So this is a really handy rule of thumb to know to assess how much debt financing a company can raise. A third application of EBITDA is to calculate EBITDA margin. This is calculated by taking EBITDA and dividing it by sales. This margin calculation can be benchmarked against peers in the same industry to assess whether the company is either under or overperforming. Many companies will specify a target EBITDA margin in percentage and dollar terms, as this loosely translates to the amount of earnings available to cover financing costs. So now that we've looked at a few applications of EBITDA, let me vent my concerns and frustrations about the metric. First, EBITDA is not defined in the accounting standards for a reason. It's a half-baked metric that ends halfway down the income statement. Like other earnings-based metrics, it's subject to a lot of professional judgment and possible manipulation. For example, consider a company that chooses to buy assets instead of leasing them. This can result in two different EBITDA calculations for essentially the same business. Secondly, EBITDA ignores the required investment in working capital. How a company manages inventory, receivables, and payables directly impacts the amount of free cash flow left over for shareholders. A lot of sins can be hidden in working capital, and EBITDA does nothing to illuminate this aspect of financial management. Third, EBITDA ignores capital expenditure requirements. Different businesses in the same industry have different CapEx requirements depending largely on the age of their existing plant and equipment. Some companies have high CapEx requirements and others are low. CapEx factors into the calculation of free cash flow once again. So there you have it, the good, the bad, and the ugly of the EBITDA metric. This list is by no means exhaustive, so feel free to leave a comment that either promotes or refutes the EBITDA metric. So until next time, I'm Blair Cook.